Dear students, in this presentation, we are going to discuss the common mistakes and some important points while you prepare the cash flow statement. I have considered very important points, and I'm hopeful that after you watch the entire video, you will be able to save your full marks in the cash flow statement. So cash flow statement is meant for 7 marks, which we have already discussed in the previous video. So these are my books which are available in the market. We have already been discussing in all the videos. And now let's have a look on the all important points. First of all, we know that a cash flow statement is prepared with the help of 3 type of activities. And first one is operating activities. So under operating activities, we are given the net profit, and this net profit can be obtained by comparing the previous year profit with the current profit. So from the current year profit, we deduct the previous year profit and we find out net profit. And this profit, if comes negative, then we put in the bracket. So what we have to do, we have to convert the net profit into operating profit before working capital changes. And how we can convert the net profit into operating profit? That what we have to do, we have to add all non-operating expenses and deduct all non-operating income from the net profit in order to obtain the net profit before working capital changes. So now we shall have a look on the non-operating expenses and non-operating incomes. What are the non-operating expenses? Non-operating expenses are those expenses which relate to your non-current assets or non-current liabilities. So how we can classify them? Any increase in the value of reserve funds and provision. So this reserve fund and provision you can see on the liability side. So if you find an increase in the value of investment fluctuation reserve, workman compensation reserve, or general reserve, or debenture redemption reserve, or if you find increase in the value of accumulated depreciation, it means the profit has been transferred to these accounts. So whenever the profits are transferred to provisions and reserve, which are meant for non-current assets and non-current liabilities, this is the non-operating expense. Second, we have the decrease in the value of intangible assets. So intangible assets you can see on the asset side under fixed assets. So when there's a decrease in the value of intangible assets, it means these have been written off. So if you see the decrease in the value of goodwill, patent right, trademark, copyright, etc., it means these have been written off from the books. So decrease in the value of the intangible assets is the non-operating expenses, so it is added in the net profit. And sometimes adjustments are given below the balance sheet. So adjustment which are relating to your non-current and non-current liabilities are also non-operating expenses. So these are in the form of when you have loss on sale of tangible assets, loss on sale of intangible assets, or loss on sale long-term investment, or loss or discount on issue of a debenture which have been written off from statement profit and loss, and interest paid on long-term debentures or borrowing bonds, and dividend payment, whether it's interim, preference, or equity. So these all expenses and losses relate to your non-current and non-current liabilities. One point I may add here, that your loss and discount on issue of debenture is written off first from capital reserve, and then it is written from security reserve, and then the balance if left, it is written off from statement of profit and loss. So any part of loss or discount which has been written off from the statement of profit and loss, it is added in the net profit in order to find out net profit, operating profit before working capital changes. So these are the examples of non-operating expenses which you add in the net profit. Next, we have non-operating incomes. Non-operating incomes are those income which relate to your non-current and non-current liabilities once again. And for this, we don't have any account in the balance sheet, just like we have seen in the case of non-operating expenses. So under this heading, we can have certain example, just like profit on sale of intangible assets or intangible assets, long-term investment, or interest received, dividend received on the long-term investment, etc. So profit or loss on the sale of intangible assets and the tangible assets, as well as on the investment. So these all belong to your non-current and non-current liabilities. So these are non-operating incomes. So these non-operating incomes are deducted from the net profit. And now we are going to discuss about the cash and cash equivalent. Under cash and cash equivalent, first we have cash. Cash includes cash in hand and balance at the bank. And what are the cash equivalents? Cash equivalents are short-term, highly liquid investments which are readily convertible into known amount of cash with insignificant risk with the maturity period of 3 months or less from the date of acquisition. So any current assets which have maturity period of less than 3 months, that is a cash equivalent. Examples of cash equivalent are treasury bills, commercial papers, short-term deposits, short-term investment, marketable securities. So normally in the question you find short-term investment and marketable securities. One more point, that is cash, credit, and bank overdraft. Though these seem to be the part of the current liability, but these are covered under the financing activities. Increase in them is basically inflow of cash, and decrease in them basically outflow of cash. Let's have further look on the cash equivalent. These are number one, current investments are treated as marketable securities if no specific information is given, just like it's basically as per the CBSE syllabus. So if current investments are given in the question and nothing is mentioned about its nature, whether its period is less than 3 months or more than 3 months, then it will be considered as a marketable securities. And a marketable security is a part of the cash equivalent. So it means the marketable securities are those current assets which have the maturity period of 3 months or less. And if the word simply the word investment, long term or short term is written, investment written whether it's a short term or long term, then it will come under the investing activity. So increase in investment, whether it's a short term or long term, it will be basically purchase of investment, and decrease in the value of investment basically will be the sale of investment under investing activities. Loans and advances, short term or long term, both come under the investing activities, just like investments. Next, now we discuss about the treatment of dividend, which are quite important for every student. And normally students remain confused about the proposed dividend. So we shall have a detailed discussion on the proposed dividend with the help of the example. Dividends can be classified into 3 categories. Number one, we have the interim dividend. Interim dividend is the dividend which is paid to the equity shareholders in the anticipation of good profits. So it is paid during the year, and now its treatment is that we will add the interim dividend in the net profit, and we will show as a payment of interim dividend under the financing activities. And sometime interim dividend is given as a percentage. So if interim dividend is given as a percentage, it is calculated on the opening balance of equity share capital. Then next we have the preference dividend. Treatment of preference dividend is quite similar to the interim dividend. So interim dividend is given during the year, whereas preference dividend is given at the end of the year before the payment to the equity shareholder as a dividend. So in case of preference dividend is calculated as a percentage given in the question. So on the basis of the percentage, we will find our preference dividend on the opening capital, and after finding the amount of preference dividend, then we show it as addition to the net profit, and we also show as a payment of preference dividend under financing activity. So treatment for preference dividend and interim dividend is totally similar or same. Now the proposed dividend. So the treatment of proposed dividend has changed due to the change in the accounting standard 4. And as per accounting standard 4 revised, what is the treatment that whenever the dividend is declared at the end of the financial year, unless until it is approved by the equity shareholder in the annual general meeting, this dividend cannot be paid. For example, if we have the financial year ending say March 2021. So at the end of this financial year, that is on March 31st, 21, the board of directors will declare the amount of dividend. And now this dividend will be approved by the shareholders in the annual general meeting. And in the annual general meeting, which may happen in the month of July, August, September, any month after 31st March. So the meeting will be held in the next financial year. So the dividend which has been declared for the year 2021, 2020 and 2021, it will be approved in the financial year 2021 and 2022. So it means the dividend which belongs to 2021 will be approved in the year 2022. So it will basically become the expenditure for the year 2022. So how we will have to give the treatment? Let's understand with the help of the practical question. So after this slide, we will discuss about it. So dividend proposed at the end of year is seen as a contingent liability as a notes to account. So you must have seen the questions where the contingent liability is given and the proposed dividend is given for 2 years, for one for previous year and one for current year. Proposed dividend given under the previous year is paid in the current financial year, and dividend proposed given under the current financial year is to be ignored because it will be approved in the next financial year and it will be paid in the next financial year. So dividend proposed given under the previous year is added in the net profit, and it is also shown under the financing activities as the payment of proposed dividend. Now let's understand with the help of 3 examples. Example number A. Here you can see that under contingent liabilities, proposed dividend given to you. So it is a notes to account, and you can see the current year is 2021 and the previous year is 2020. In the previous year, dividend was proposed for rupees 1 lakh. So this must have been approved in the next financial year, that is 2021. So the dividend which has been proposed in the year 2021, it will be approved in the next financial year, that is 2022. So what treatment we shall consider? That we shall ignore the treatment. We shall ignore the treatment for the dividend for the current year, and we shall consider only the dividend for the previous year. So this 1 lakh rupees will be added in the net profit as a proposed dividend, and the same amount will be shown as a payment of proposed dividend under the financing activity. So I hope this must be very much clear to you. Now we are going to make a little change in it. So same question. Now what's the change in it? That we have added one more item, that is dividend payable. So dividend payable is given to you in addition to the proposed dividend. So dividend payable is rupees 25,000 in the current financial year. What shall it mean? It means that the last year, in the previous previous year, the dividend was proposed was rupees 1 lakh, which must have been approved in the current financial year. And out of this 1 lakh rupees, 25,000 is yet to be claimed. It is an unclaimed dividend or dividend payable. It means out of 1 lakh rupees, 75,000 has been paid. So 1 lakh will be shown in the net profit as proposed dividend, and 1 lakh minus 25,000 will be shown as a payment of proposed dividend under the financing activities. I hope it must be clear to you. Now let's make little more change in the same question. So what I have now done, that under dividend payable, I have written rupees 15,000 the previous year. So now what we need to understand, that in all the question, dividend proposed for the current year has to be ignored completely. So what we have understood, that dividend of rupees, out of dividend of 1 lakh, 25,000 is yet to be paid. It has not been claimed. And in the previous year, 15,000 was not claimed and was remained unpaid. So the dividend which remained unpaid in the previous year, that must be belonging to the financial year 2019. So when the dividend for the year 19 was paid in the year 2020, rupees 15,000 remain unpaid. So when we will paying the dividend in the current financial year 2021 for the previous year, so out of that 25,000 is unpaid, and we shall assume the dividend which was unpaid in the previous year must have been paid in the current year. So what we'll do, out of 1 lakh rupees, we shall deduct 25,000 which is unpaid, and we shall add 15,000 which must have been paid during the current year. So 1 lakh minus 25, 75,000. 75 plus 15, that is 90,000, will be shown as a payment of dividend under financing activity. So this was a most crucial case in the case of proposed dividend. I hope it must be clear to you, or otherwise you can reverse the video and see it once again. And now provision for tax. Provision for tax, in the notes to accounts, you may be given the short-term provisions, and under short-term provision, you will be given the figures for 2 years, one for the current year and for the one for the previous year. Here, current year is 2013 and the previous year is 2012. So, how we will treat it? If there is no additional information given in the question. So tax which have been provided in the previous year, it shall be paid in the current year, and the tax which have been provided in the current year, it shall be paid in the next year. So the provisions for tax which belongs to previous year, it will be deducted from the cash generated from operating activities. And the dividend provision for tax for the current year, or tax provided for the current year 90,000, it will be added in the net profit before tax. So I hope this must be clear to you, and statement is also written before you. And now one more case is there, that if you are given the information on the payment of tax, so information is given to you that tax has been paid rupees 30,000. So if any adjustment is given to you regarding provision for tax, then you shall require to prepare provision for tax in the working note. So in the working note, first you will write the opening and the closing balances. Provision for tax is the part of liability, and the liability always have the credit balance. So first we will write the opening balance on the credit side by balance BD 80,000 rupees. And we shall write the closing balance on the debit side to balance CD, that is 90,000 rupees. Okay. Then after this, we shall consider the adjustment, which is tax has been paid with 30,000. So tax has been paid with 30,000. So we shall make the entry provision for tax account debit to bank. So on the debit side of provision tax, we shall write to bank. In the bracket, we shall write tax paid. And now we shall make the total debit side. 30,000 plus 90,000, 1,20,000. This 1,20,000 will be written on the credit side. And out of 1,20,000, we shall get 80,000. So rupees 40,000 is basically the amount of tax provided during the current year. So this is your balance figure. So tax provided will be added in the net profit before tax, whereas tax paid with 30,000 will be deducted from cash generated from operating activities in the last under the operating activities. So one more thing you need to keep in the mind. Sometime tax provided may be given in the adjustment. If tax provided is given to you, then you will write this information on the credit side and you will find tax paid on the debit side. Okay, so if tax paid is given to you, then balance figure will be tax provided, and if tax provided is given to you, then balance figure on debit side will be tax paid. I hope provisional tax must also be clear to everyone. And now I'm going to consider the adjustment on the fixed assets. So under this, we have considered two cases. Let's have a look on the first case. Under first case, where you are not given the provisional depreciation. Provision for depreciation is known with the different names, just like accumulated depreciation, reserve for depreciation, or 3 to 4 different names are given. So provisional depreciation means that depreciation is accumulated year after year, and it is not deducted from the assets. So two separate accounts are prepared. One is the tangible asset, and other is a tangible fixed asset, and other is the accumulated depreciation account. So unless or until there's a change in the value of fixed asset, the accumulated depreciation keep on increasing. And whenever there's a sale in the fixed asset, then the fixed asset value will decrease, and also the proportionate amount of depreciation will be reduced from the accumulated depreciation account. So let's understand with the help of this example here. Here we are given the plant and machinery, where the opening balance is 4 lakh and the closing balance will be 5 lakh. Okay. So, and adjustment is given to you that depreciation charge on the machinery was 50,000. And then one more adjustment is given to you that a part of plant and machinery whose book value on 1st April 12 was with 30,000, that is the beginning of the current year or at the end of the previous year, was rupees 30,000, and depreciation on it rupees 5,000 was at the time of sale, and it was sold at 10% loss. Find flows of cash under investing activities. So now what you will do, you will prepare plant and machinery account, and plant and machinery as it's asset. So opening balance asset will be written on debit side. So first you will write to balance BD rupees 4 lakh rupees, and then you will write the closing balance on the credit side. At the last, you will write here in the last buy balance CD rupees 5 lakh rupees. So after writing opening and closing balances, then what you will do, you will consider the adjustment. Here under the adjustment, what you are given, that a part of the plant and machinery that of rupees 4 lakh up to rupees 30,000. So a part out of 4 lakh to the extent of 30,000 has been discarded, and it has been sold during the year. When it was sold during the year, till at that time depreciation was provided for 5,000. So now we will see what is the value of the machine sold after depreciation. 30,000 minus 5,000, that is 25,000. So 30,000 is the book value in the beginning of the year, and whereas 25,000 is the book value at the time of sale. So the book value of 25,000 has been sold at 10% loss. So 10% of the book value on the date of sale will be 2,500 rupees. So 25,000 minus 2,500, remaining balance will be 22,500. It means the asset has been sold for 22,500 rupees. So 30,000 has been divided into 3 parts. One is 5,000. The remaining 25,000, out of the remaining 25,000, 2,500 is toward loss on sale, and rest 22,500 is basically the amount of sale, that is in the form of cash or back. One more important information you always need to keep in the mind, that whenever total depreciation is given to you, and unless or until some special information given to you, you will always assume that the total depreciation always include the depreciation of the sold asset. So it will be assumed that out of 50,000, if 5,000 has been charged on the sold part, it means remaining 45,000 has been charged on the remaining assets, as well as if new asset has been purchased. Okay, so first we will show the depreciation on the credit side. As with the depreciation, the value of assets decreases. So asset decrease on the credit side. On the credit side, we will write depreciation 50,000 rupees. So this is basically 45,000 plus 5,000. And 30,000 has 3 parts. One is 22,500, that is the sale. So with the amount of sale, value of asset decreases. So we will write on the credit side by bank bracket with sale, that is 22,500 rupees. And 2,500 is a loss. So with the loss, again, the plant and machinery will reduce. So it will reduce on the credit side. We will write by loss on sale 2,200 rupees. And the depreciation asset sold, that is already included in the depreciation account of 50,000 rupees. So after showing the total amount of depreciation and the sale price, including loss on sale, we shall close the credit side. And after we close the credit side, we shall take the total of 5,75,000 on the debit side. Out of it 5,75,000, if we deduct with 4 lakh, 1,75,000 is the balance figure, and this is basically the purchase of plant and machinery. Okay, so now how you have to show all these different amounts in the CFS. Now what we will do, that we shall ignore the figures which we have taken from the balance sheet, that is opening balance and closing balance, because they have the double effect of the balance sheet itself. We shall show the effects of all the adjustment entries and the balance figure. So after ignoring rupees 4 lakh and rupees 5 lakh, now we shall give the double effect of the rest of the figures. So depreciation is a non-operating expense. It will be added in net profit. And then we have the sale proceed. Sale proceed will be shown under the financing activities, sale of plant and machinery. And then loss on sale is non-operating expense. It will be added in the amount of net profit. And then on the debit side is the balance figure. and it will be shown as a purchase of plant and machinery under investing activities. So this way we have shown the double effect of all adjustment and the balance figure. This important information you always need to keep in the mind, that whenever you take any information from the balance sheet, okay, and you show in the any account in the note in the adjustment or in the working note, then it is second effect. But whenever you have some adjustments or balance figure, it will always be shown at the two different places, one in the working notes and another in the question result. Okay, now next we have one more question for you, where you are given the provision depreciation as well as the asset account. So asset account here is plant and machinery, and you are also given the provision for depreciation. What is the meaning of provision depreciation here? That in the beginning of the year, you had a plant and machinery at the original cost, at the price paid, rupees 4 lakh. And against rupees 4 lakh, the company had charged depreciation to the extra rupees 1 lakh. So 1 lakh is the depreciation on the total value of cost of the asset of 4 lakh rupees. But at the end of the year, where the plant and machinery is rupees 5 lakh and the proven depreciation is 1,50,000, it means against rupees 5 lakh, the depreciation is 1,50,000 rupees. And now one more point I would like to add before I proceed further. Suppose if no adjustment is given in the question, and these two accounts are given, that is plant and machinery and proven depreciation, how you will consider it? So if no adjustment is given to you, increase in the value plant and machinery will be considered as a purchase. Okay, and increase in the value of provision for depreciation will be considered as a depreciation provided, and that will be added in the net profit. Okay, but when adjustments are given, then you will have to prepare both the accounts and you will have to show the relevant effects of the different amounts. So now let's see what adjustment we are given to you. We are given one adjustment, that is a part of the machine whose original cost is 50,000, on which depreciation from the date of purchase till the date of sale will be 20,000, was sold at 20% profit. Okay, so now what you need to understand, that a part of plant, total machine was 4 lakh rupees, and out of this 4 lakh rupees, a part of machine which had a cost of 50,000, okay, on which depreciation from the date of purchase till the date of sale will be 20,000. So 1 lakh is the depreciation against rupees 4 lakh, and 20,000 is the amount depreciation against rupees 50,000. Okay, so now what we can see, that the original cost of the asset rupees 50,000, whereas depreciation, total depreciation provided from the date of purchase till the date of sale is 50,000. We have nothing to do with the dates when we had purchased this and when we are going to sell it. What we have to do, we have to consider the different figures only. So out of 50,000, if we did 20,000, the remaining value will be rupees 30,000. This 30,000 will be known as book value at the time of sale. And now on this book value, we shall find out profit or loss. So we have sold this asset at 20% profit. So 20% of 30,000 will be 6,000 rupees. Okay, so 6,000 is our profit, whereas book value was to be 30,000. So asset has been sold above the book value. It means 30,000 plus 6,000, asset has been sold for 36,000. So now we have to show this adjustment in the accounts. So what we'll do, first we will prepare both the accounts. We will prepare plant and machinery account, and we will then prepare provision depreciation account. So in the plant and machinery account, as it is asset always a debit balances. So we shall write in the plant and machinery account to balance PD 4 lakh rupees. And then we'll write the closing balance by balance sheet rupees 5 lakh at the end of the account on the credit side. So, and then we will write provision depreciation balance. So in the provision depreciation, we will write by balance BD rupees 1 lakh, and closing balance will be written on the debits in the last. We will write to balance CD 1,50,000 rupees. Okay, so after writing the opening balances and closing balances of both the account, now we will show the adjustment part. So 50,000 has three parts. That one is the amount of depreciation 20,000. remaining value is 30,000, and 30,000 is basically not going to weigh that 36,000 is the amount of sale and 6,000 is the amount of profit. Okay, so how you will show it? So as you have sold the asset, when you sell the assets, asset value of asset decreases. On the credit side of the plant and machinery, we will write by bank account, that is sale of plant or machinery, 36,000. Okay, and as loss on sale was shown on the credit side of plant and machinery in the previous case, so if a loss on sale was shown on the credit side of plant and machinery, because loss on sale reduces the value of plant and machinery, then profit on sale will increase the value of plant and machinery. So loss on sale is shown on the credit side of plant and machinery, then profit on sale will be shown on the debit side of plant and machinery. So on the debit side, we will show two profit on sale, 6,000 rupees. Okay, now now after that, what we'll do, we will write by profit depreciation. How much? That is 20,000 rupees. So we will write profit depreciation 20,000 rupees. And now what we'll do, after writing profit depreciation, then we will close it. We will close it. We will make a total, and total is 5,56,000. And then out this total will take on the debit side, and we shall deduct 4 lakh rupees and then 6,000. The balance figure, that is 1,50,000. It is increasing the value of plant and machinery. So this will be considered as a purchase of plant and machinery. Now, after closing this account, we shall come to the profit depreciation account. So we have already written the opening and the closing balance. What we will do next, the profit depreciation which we have written on the credit side of plant and machinery. So just remember that in the previous case, we had written by depreciation because there was no profit depreciation account. But in this question, we have written profit depreciation account. So its second effect will be shown on the debit side of plant and machinery account, profit depreciation account, and not in the net profit. So after you transfer this 20,000 from the credit side of plant and machinery on the debit side of profit depreciation account, now we will close it. We will make the total on the debit side, that is 1,70,000, and this total will be taken on the credit side, 1,70,000, and on the credit side you find the balance will 70,000. So this is basically the amount of depreciation charge on all the assets available to us. So it will return us by depreciation. Okay, so now the next thing, how to show the effects. Just ignore the opening and closing balances of plant and machinery profit depreciation, because these are second effects already have in the balance sheet or the notes in the accounts. So just show the double effects of all adjustment and the balance figure. Now let's start from the plant and machinery itself. We have written here by bank. So it is sale of plant and machinery. Under investing activity, you will write sale of plant and machinery, 36,000. Okay. Then profit depreciation, its second effect has already been shown on the debit side of plant and machinery. Then come on the debit side, there is profit on sale. This profit on sale is basically non-operating income, and non-operating income will be deducted from the net profit. So it will be deducted from net profit, and then we have the balance figure, that is a purchase. So under investing activity, we will write purchase of plant and machinery. Okay. So what we have done right till now, that we have just tried to cover the important and valid points, and we have tried to cover all these value points with a very short span of time, and we have tried that you are able to save maximum time at this time of preparation examination. So if you find any doubt, if you find any doubt, or if you want to have any clarity, the phone number is given to you. You can just WhatsApp your query. So all the best for the examination. Thank you, everyone.